At first glance, it sounds counterintuitive. In competitive markets, the assumption has always been that to win, you must do more. More products, more expansion, more hiring, more features, more markets. For years, growth strategies were built around expansion in every direction. But today, a surprising pattern is emerging. Some businesses are not thriving because they are doing more. They are thriving because they are doing less. This shift reflects a deeper change in how companies define strength. In an environment shaped by higher costs, tighter capital, shifting demand, and constant uncertainty, complexity has become a liability. The more moving parts a company has, the harder it becomes to control outcomes. And in volatile conditions, control is everything. Why are some businesses thriving by doing less? The answer begins with focus. When companies narrow their priorities, they concentrate resources where they generate the highest return. Instead of launching multiple new product lines, they refine their most profitable offerings. Instead of expanding into distant markets, they deepen their presence in regions where they already understand customers. Instead of chasing every trend, they double down on what they execute best. This discipline reduces waste. Every new initiative requires management attention, capital allocation, operational support, and marketing effort. When too many initiatives compete simultaneously, performance often weakens across the board. By doing less, companies reduce internal friction. They simplify execution. Operational clarity is one of the biggest advantages of doing less. A streamlined product portfolio is easier to manage. A focused strategy is easier to communicate. A narrower customer segment is easier to serve exceptionally well. Simplicity enhances precision. Cost control is another major factor. In recent years, input costs, borrowing costs, and labor costs have all risen. Businesses that previously relied on rapid expansion to offset inefficiencies are finding that model harder to sustain. By reducing complexity, companies lower overhead. Fewer product variations mean leaner inventory. Fewer geographic expansions mean lower logistical strain. Fewer side projects mean tighter capital discipline. Doing less also improves margins. When companies eliminate underperforming divisions or low-margin services, they concentrate on high-value segments. This strengthens profitability without necessarily increasing revenue. In today's market, investors are often rewarding margin stability more than top-line growth alone. There is also a cultural benefit. Organizations stretched across too many priorities often suffer from burnout and misalignment. Employees are pulled into shifting initiatives. Teams lose clarity about core objectives. When leadership simplifies strategy, it creates alignment. Everyone understands what matters most. The rise of doing less is closely tied to risk management. Each new market entry, product launch, or acquisition introduces uncertainty. While expansion can drive growth, it also multiplies variables. In unpredictable economic conditions, reducing variables enhances resilience. Focused businesses can adapt faster because they are not juggling excessive commitments. Technology has played a role in enabling this shift. Advanced analytics allow companies to identify precisely which products, customers, or regions drive profitability. Data makes it easier to cut what underperforms and reinforce what works. Instead of relying on instinct, leaders can make evidence-based decisions about where to narrow scope. Some of the strongest performing companies today are those that have exited non-core operations. They have divested side businesses. They have simplified supply chains. They have reduced headcount in non-essential areas while protecting critical capabilities. These moves are not signs of retreat. They are strategic recalibrations. Customer behavior also supports this trend. In uncertain times, customers value reliability and clarity. Companies that offer a clear, well-defined value proposition often outperform those with sprawling offerings. When businesses focus on doing a few things exceptionally well, customer satisfaction often increases. Doing less does not mean shrinking ambition, it means concentrating it. Instead of spreading effort thinly, thriving companies are channeling energy into areas where they possess competitive advantage. This creates depth instead of breadth. Financial flexibility is another outcome. When companies limit expansion to core strengths, they preserve cash flow. Stronger cash positions provide optionality. They allow businesses to respond to opportunities when conditions are favorable rather than reacting defensively when conditions tighten. The broader economic environment reinforces this discipline. Demand in many sectors has become less predictable. Consumer confidence shifts quickly. Enterprise budgets fluctuate. Under these conditions, businesses that rely on constant expansion to sustain momentum face greater risk. Those that optimize their core operations can generate steady performance without overextending. There is also a strategic signaling effect. Companies that demonstrate the willingness to cut projects, delay expansion, or divest distractions signal seriousness about long-term sustainability. Investors increasingly view focus as a sign of maturity. Importantly, doing less can actually unlock better innovation. When organizations eliminate distractions, they create space for deeper thinking. Teams can refine existing products more thoroughly. They can improve quality rather than rushing quantity. Focus fosters excellence. Over time, the benefits compound. Leaner operations create stronger margins. Stronger margins build financial resilience. Resilience enables thoughtful growth. Thoughtful growth reduces volatility. What begins as a decision to simplify can evolve into a durable competitive advantage. In previous business cycles, expansion often masked inefficiencies. Growth covered up operational weaknesses. Today, those weaknesses are more exposed. Doing less forces companies to confront inefficiencies directly. It pushes leadership to identify what truly drives value. The businesses thriving in this environment understand that scale without control is fragile. They recognize that complexity can erode profitability. They know that disciplined focus can outperform aggressive sprawl. Why are some businesses thriving by doing less? Because they are concentrating on what works. They are removing distractions. They are protecting margins. They are strengthening balance sheets. They are simplifying execution. They are trading breadth for depth. In volatile markets, restraint can be more powerful than expansion. Simplicity can outperform scale, and focus can generate stability where complexity creates risk. Doing less is not about shrinking vision, it is about sharpening it. And in today's business landscape, that sharpened focus is proving to be a winning strategy.